Every day, billions of dollars move through something most people never actually see: the stock market. A headline appears, a company announces earnings, interest rates change, and suddenly prices move. But what is really happening behind those green and red numbers? Who is buying? Who is selling? And when you buy a stock, where does your money actually go? In the next few minutes, we'll build the whole picture, simply, step by step. Let's begin with a company. Imagine a fictional electric bike business called North Star Bikes. It designs bikes, pays employees, buys materials, and sells products to customers. To grow, it may need money, perhaps to open new factories, develop better batteries, or sell in more countries. One way to raise that money is to divide ownership of the business into many small pieces and offer those pieces to the public. Each small piece is called a share, or a stock. If you own one share, you own a very small fraction of that company. It does not mean you can walk into the factory and take a bicycle home, but it does mean your financial result is connected in a small way to the company's success or failure. If the company grows profits, creates valuable products, and investors become more optimistic about its future, people may be willing to pay more for its shares. If the business struggles, the opposite can happen. The first time a company sells shares to the public is called an initial public offering, or IPO. In that first sale, money from investors goes to the company, assuming the company is issuing new shares. North Star Bikes receives capital, and the investors receive ownership shares. That is the primary market. Think of it as buying a new book directly from the publisher. The company gets the money, and a new owner gets the book, or in this case, the share.
But after that first sale, most everyday stock trading happens somewhere else, the secondary market. Here, investors buy shares from other investors. If Maya buys one North Star share from Alex, Maya's money goes to Alex, not directly to North Star Bikes. The company is still affected by the market price, because that price reflects what the world thinks its ownership is worth. But it does not receive cash every time someone trades one of its existing shares. So, where do Maya and Alex find each other? Usually, they do not meet directly. A stock exchange is an organized marketplace that helps match buyers and sellers under a common set of rules. Today, this matching is largely electronic. An investor places an order through a brokerage platform. The order reaches the marketplace, and the system looks for a compatible order on the other side.
Now for the key question. How is the price decided? At any moment, some people want to buy and some want to sell. A buyer might say, "I'm willing to pay up to 50." A seller might say, "I'm willing to sell for 51 or more." Those offers do not match yet. When someone agrees to buy at the seller's price, or a seller agrees to accept the buyer's price, a trade can happen. The latest price at which a trade takes place becomes the current market price you see on a chart. Prices move because opinions and circumstances change. Maybe North Star announces strong sales. More people may want to own the company than sell it, pushing the price higher. Or perhaps a competitor launches a better product, costs rise, or the economy slows down. More owners may want to sell, or fewer buyers may be willing to pay the old price. Price movement is not a magical signal from a screen. It is the visible result of changing expectations, new information, and the ongoing negotiation between buyers and sellers. In the short term, markets can be emotional. Fear, excitement, headlines, and uncertainty can all change what people are willing to pay. That is why a share price can move more sharply than the business itself changes in a single day. Over longer periods, though, a company's ability to create real value through sales, profits, cash flow, and durable advantages matters enormously. The price and the business are connected,
but they are not the same thing. You'll often hear people say, the market was up today, but there is no single market number. Usually, they are referring to an index, a carefully designed basket of shares used to track part of a market. One index might follow large companies in one country. Another might track technology businesses. Another might represent companies around the world. An index is like a dashboard. It helps you see the broad direction of a group, but it does not tell the full story of every company inside it.
People can participate in markets in different ways. They can buy individual shares, which means researching particular companies. They can buy funds that hold many shares, such as index funds or exchange-traded funds, often called ETFs. And they can combine different types of investments, depending on their goals, time horizon, risk tolerance, local rules, and personal circumstances. There is no universal perfect choice. The useful starting point is to understand what you own, why you own it, the costs involved, and the risks you are taking. To access the market, most individuals use a broker. A brokerage is a regulated service that can place orders, hold assets in an account structure, provide statements, and charge fees or commissions depending on the service and location. A broker is the bridge between an investor and the marketplace. Before using one, it is worth understanding the regulations in your country, account protections, fees, tax treatment, and what happens if you need help. Stocks can create returns in more than one way. A share may increase in price, and some companies distribute part of their profits to shareholders as dividends. But both are uncertain. Prices can fall. Dividends can be reduced or stopped. A company can perform badly, and even a strong company can be bought at a price that leaves little room for disappointment. Risk is not simply a red line on a chart. It is the possibility that reality turns out differently from what you expected, and that you may lose money. One way people try to manage company-specific risk is diversification, spreading exposure instead of depending entirely on one business, one industry, or one country. Diversification does not guarantee gains, and it cannot remove every risk. When broad markets fall, many investments can fall together. But it can reduce the damage if one company or one area performs especially poorly. In simple terms, putting every egg in one basket can make one broken basket a very big problem. Time horizon matters too. Money needed next month is different from money intended for a goal many years away. Markets can be unpredictable over short periods, which is why treating them like a quick money machine can be dangerous. A longer time horizon does not make an investment safe, but it can give a business cycle and compounding more time to work. The important point is not to copy someone else's plan. It is to connect your decisions to your own goals, responsibilities, and ability to handle uncertainty. Market news can be useful, but it is designed to compete for attention. When you see a dramatic headline, pause before reacting. What actually happened? Is the information about one company, one industry, one country, or the whole global economy? Is it new information or an old fear with a louder headline? And does it change the long-term facts you were watching? Learning to ask better questions is more valuable than trying to react faster than everyone else. Let's put the whole journey together. A company needs capital and may issue shares. In the primary market, investors provide money and receive ownership. Later, in the secondary market, buyers and sellers trade those existing shares through brokers and exchanges. The price changes when new information changes expectations, and people adjust what they are willing to pay. Indexes help us see broad market movements. And the choices people make, individual shares, funds, ETFs, or something else, come with different trade-offs, risks, and responsibilities. The stock market is not just a scoreboard of green and red numbers. It is a living marketplace for ownership in real businesses, shaped by people, information, expectations, and time. You do not need to predict every move to understand how the system works. Start with the basics. Learn what you own. Respect risk. Ask better questions. And remember, good market education is not about finding a secret shortcut. It is about becoming harder to confuse. This is ticker theory. Learn the market, think independently.